All right, so we are live on Facebook. Thank you, Bill and Lily, for joining us today from Approved Mortgage.
Thank you for having us.
So we're just gonna ask some questions, mortgage related, real estate related, about what's going on right now with the shutdown and everything. So Laurie, why don't you kick us off and ask the first question?
Well, yeah, I just wanted to ask Bill, I mean, we've been talking about the shutdown and what's been going on, but I know there'd be an update for us at this point. You know, how's it affected mortgages and, you know, what's going on with the refi market? Are you still getting pre-approval requests, and what's going on right now?
Well, it is slowing down significantly, and there's a lot of different components, right, of closing a mortgage that there's different interpretation to, and from notaries to title companies and appraisers. But it's definitely slowing down. There's, you know, this is coming to us, Dave, you know, every day we get something different. So the mortgage market environment, just from an overlays on how tighter it's getting right now to actually do a mortgage every day, really is just getting tougher. Now, we don't expect it to stay that way. We expect things to loosen back up in our spring market, essentially, to, instead of being now, this is kind of like January, February, or December, February, December, January, February, and I think we're going to loosen back up sometime in July, you know, August is what we're saying. But you know, the biggest component that we're seeing, why a lot of lenders are really stepping back quickly right now, is all the forbearance forgiveness out there. And you know, the biggest questions that we get, everyone from the last 6 months to a year is, you know, do I qualify for a forbearance, and does that mean I just don't have to make my payments for 1 month, 2 months, 3 months? So when you originate a loan and people are under the assumption that they don't have to make their payment, that means all the lenders that are originating, right, they're going to get defaults on them, which means they have to pay back any commission earned, plus we have a lot of costs associated with originating that mortgage. So those numbers are expected to rise, and that's the biggest reason. Once we can get back to a normal mentality of, I have a mortgage and I'm supposed to make my payment, and I think a lot of it's just misinformation. For example, you know, forgiveness would be you don't have to make the payments back. That's not what happens. If you have a hardship, you know, once your loan is with a servicing department and you were to call up, they can give you a forbearance. Maybe they give you a month to see if you get back to work, or 2 months. And then what happens is your payment goes up afterwards, so that you will make that payments, those payments will increase, so that you make those 2 months of payments that you skipped, you're paying that back. So, you know, I think there's just a lot of that misconception that as that kind of works through the system, you know, I think things will improve a little bit in the mortgage market. But because of that, all of the underwriting guidelines are just really, really tightening up.
Okay. So like every day you're getting new guidelines.
Every day that, you know, it's credit scores, any lower credit scores in the lower 6s, 500s, for the most part, are having a really difficult time closing. We sell direct on a lot of our products, and you know, there is exceptions. The biggest one that they want to see right now, if you're applying for a loan, is that you understand that you're going to be making your payment, and the best way to do that is to have reserves, right? So that's typically a calculation. So if you had a $2,000 mortgage payment, a lot of companies want to see at least 2 to 3 months reserves after that closing. And really, they want to see more. You know, Fannie, Freddie, which is conventional loans, they like to see people with more 20% down and a bigger bank account is much more appealing to a lender than it's ever been. Because if they were unemployed or furloughed for a short period of time, they're still going to probably make their payments because they're able to.
Okay. Speaking of furloughs, if somebody is in the middle of a transaction and they get furloughed, is that all the bets are off? They can't close on that property?
No. And so we're originating loans, and we have loans that are in the pipeline, and it's really unfortunate because you're seeing it across the board where, you know, it's the day before closing and they were furloughed. Well, we used to be able to do a verification of employment 10 days prior, and now everyone's requiring that verification to be redone the day it funds. So you can have someone that's looking to buy a house right now and literally lose their mortgage the day before closing.
Wow. Oh,
And it
okay.
can be extended, and, there's nothing wrong with, having an extension, and that can stay into underwriting, and there's going to be requirements as soon as they were off furlough. Or you could have two people on the loan. If the other person was not furloughed and can qualify with their income, then they could be fine too.
Okay. All right.
Wow.
What about the rates? They went up initially and now they came back down. So can you tell us what they're doing? And
Yes, there's been so much uncertainty, but what happened was they shot up because of all of these things that were going on. And mortgages are sold in the secondary market. And the Federal Reserve basically a couple weeks back came in and started buying those mortgage-backed securities, which are bonds, very heavily. So now they've secured like in the 3 range, in the mid to lower 3 range. And, they're moving around a little bit, but not with a ton of volatility. When we come out of this, I think the unemployment number today was pretty astronomical, jumping up past 10% already. So we're going to be in a recession, right? We may V-bounce out of it quickly, but typically when you're in a recessionary type market, you're going to have lower interest rates. So I do expect them to stay lower for an extended period of time. And I think a lot of people are still going to refinance, even if they're on furlough now, because you cannot refinance even and take advantage of the lower rates if you're on furlough there. So once people get back to work, I don't anticipate the rates jumping crazy quickly or anything like that.
Where are we at with the rates? What is it today?
So they're right. It really depends on the credit score and the program for the most part, but it's mid to lower 3s on programs across the board. And the 15 years you can get. A lot of people that are in good financial positions are looking, to refi, and the rates might be in the upper 2s.
Wow.
Depending on their credit. So I think a lot of people, when this is done and people get a little more comfortable, they're going to say, wow, I should really look at potentially doing it, either a debt consolidation, because I had other credit card debt and things that I might have ran up during these times, and I have good equity in my home, and that's the cheapest cost of funds for the roof over your head. Or they're going to say, this is a great opportunity. If I'm staying in this home, maybe I go into a 15-year loan. And I think once things normalize right now, because cash out, taking money out of your house is a little bit more restrictive right now, they might decide to pull money out for other investment opportunities that typically when you come out of this kind of, and we've never seen anything like this, but to relate it to something is more of like a 2008, and you came out, there was such tremendous opportunity, from people panic selling of businesses, panic selling of homes, people that just were not in a very good cash position.
So Bill, do you think that this is going to have downward pressure on home prices, existing home prices?
Typically, I think that residential real estate does pretty well. And the indications from me are that it's still going to do pretty well. Could you have a slight tick down? I believe so. But if we can come out of this, and if you look at some of the Goldman Sachs and larger brokerages, how they're predicting that you could come out of this, right, is that you're going to still have a good accommodating real estate market. I don't know how the service industry is going to come out of this. So I look at different segments of real estate and how it might do well or might not do well. I also think commercial real estate might have a little bit, I think it's going to have a more difficult time than residential. People learning to work from home like this, and then cost cutting that typically goes on during these times, I think is going to lead more people to having virtual type space or having a smaller space. And I think I think we're going back to work right after this, but how many restaurants are we going to? Are we sitting 6 feet apart in those restaurants? Because all of those spaces were not set up to be cost-effective businesses with everyone sitting in that distance. So
Right.
now I just think we're looking at a different world. Even when you look at China, they're back to work, factories and all those places, they're technically back to work, but I don't think their restaurant industry has recovered quite yet.
So I spoke to a buyer yesterday who said, so when are rates going to bottom out? And I said, well, that's something I actually asked him to speak to you guys about that. But, how do we, I don't know that we can answer that question or that we should answer that question, but how do we think about it? Is it that we expect to see a number of additional governmental interventions over, a over this crisis, and then at a certain point something happens, and
Yeah. Well, right now, technically they should be lower than they are. If you look at like even a 10-year Treasury and the yield that that's based off of, and that was always a good indicator to the mortgage-backed security market. So they should be a little bit lower, but there's just so much risk and so much uncertainty on people making their payments that's not been the approach. I mean, it's a supply-demand issue too, but whether or not we're in the heightened panic portion of this whole situation, I think, right now. And then we're going to come into the earnings, second quarter earnings of companies, and you're going to see kind of the damage. So I think the pure panic and the unemployment is at its highest rate right now. I think we're going to improve a little bit from that, but then I think our company earnings aren't going to be very good at all. So that's why a lot of people are just predicting you kind of have a market that's where it's at right now, and it may improve a little bit, but probably not much. If you have a job and you were refinancing and it made sense for you, and you get pretty close to closing, because most lenders are making you get closer to closing because the chances of furlough or unemployment are so great right now. So a lot of people with us are starting to refinance, and we're getting them as close as we can to closing, and then we're pulling the trigger if it makes sense for them. It's like trying to time the bottom of the stock market, because I don't think we've seen the bottom of the stock market. We've seen a bounce recently. But I think when those company earnings start to come in, I think that's when you're going to see carnage, in particular in the stock market at that time.
What's the timing usually on the majority of earnings? Does it tend to be year end or June, July?
Just the quarterly earnings that come out. Yeah. So 4 times a year, quarterly.
Okay, 4 times. Yeah.
Mm-hmm.
Well, Bill, what about, it's one thing if you get laid off or furloughed, but for independent contractors like a realtor or someone that, has their own business, and you're trying to, you're trying to buy a house or you're trying to refinance, what are they looking at? You're still bringing in some income. Like as a realtor, we still have a few things on the books, but if you have a person like that, finance, what kind of documentation?
That's a great question, because that's a tougher one right now. And it's changing every day, but it's been more case by case. And I can tell you that lenders, we're going back to like way more of a common sense underwrite than ever before. So when you have reserves and there's still money coming in, and you're a business that might be not a necessity right now, but is going to be lifted from that pretty soon, I think you're in a good position. If you're going paycheck to paycheck in those industries, that's a much more riskier loan.
Mm-hmm. What about, like, in the process of a couple things we're dealing with our team is we did have in under contract transactions, some have had appraisals already, many have not. So I know there's drive-bys, and then, I got a call from an appraiser and he wants to come in. And I said, well, I thought you were doing drive-bys. He said, well, we need to come inside. So what's the protocol on that? Can the seller refuse that?
Oh yeah, absolutely. I mean, if you're selling the loan direct for the most part, especially on a Fannie Freddie, on a conventional loan, I mean, we're getting almost all waivers or AVMs, which is an automated appraisal essentially that's being done. So for the purchase market especially, we haven't experienced much of an issue there.
So the appraisals come in. So one of my sellers said, well, maybe I should let them in because maybe the appraisal will come out more accurate or more favorable versus just driving by. They can't see my brand new kitchen that we just put in. So what do you think about that?
It's based off the appraiser if they want to do it. Some companies we're handling it differently, by doing FaceTime and things like that, I've heard. So I think the different appraising companies are handling it differently on whether or not they're going in the house or taking the photos from the outside and having pictures and FaceTime sent. Some are being creative, but it looks like more of the guidance though is now not supposed to be going into people's homes.
Yeah.
So if you need a full appraisal right now, it's just not working. But we're getting anything that is not a cash out loan. for the most part, we're getting waivers on the majority of our appraisals, but that's refinances. So
Do you think that the appraisers are going to be more conservative? I mean, I know that's a loaded question, but if they are doing it, you know, virtually or by a drive-by?
well, virtually is just, it's not even through the appraiser. So they're not even putting it together. Yeah, it's a, you know, you tap into the AVM, these virtual systems essentially that will give you an automated appraisal.
Oh,
So, you know, it's not a great thing necessarily that the system functions without appraisers, right? Because they don't want things to go automated. So it depends on the house. I mean, if you have a nicer interior that you updated afterwards and there's no pictures online and, you know, you bought it and kind of fixed it up, it doesn't work as well for you. So I think some of those are on hold, you know, and I know a lot of people aren't, it's really tough. And you tell me, I mean, to get people into homes right now and actually sell them versus the virtual. So I don't think we're, you know, we were able to kind of ride out the purchases that were in there for the most part under contract prior to, you know, the 30-day period. But I think until this gets lifted or until, you know, the governor makes a change in real estate, which it doesn't look like that's happening, I think we're in a shorter period of time right now where if you need an appraisal on a transaction, it just might not happen.
right. Yeah. What other questions do we have? Anybody else have a question?
Yeah, I'm curious about the investment market. So I think on the one hand, you know, you have people who need to get equity out of their current properties. So what's the scenario for them versus those who have perhaps the cash right now? Well, I mean, I guess the cash right now that's not an issue for you. So maybe just talk about the former. Yeah.
Cash is king right now, more than ever, right? And even when you come out, even though you're going to be able to still get an investment, you know, property loan, they're going to be a lot more difficult. One of the criteria is from a reserve standpoint, we talked about having 1 or 2 months reserves. If you have multiple investment properties, they're adding back like 6 months requirements that used to be on here for every property. So if you had 5 properties and, you know, each of those mortgages, you need cash reserves or in your, you know, retirement accounts, cash equivalent of 6 months payments for each one of those properties.
Oh.
And that's come back into play, and that was there for years after, you know, the crash of 2008. So I do expect some of these things are going to stay for a significant time. So it's not easy. You know, if you have cash, you can buy investment properties, but just understand that you're even a bigger risk right now if you have investment properties. And this is coming from someone, I mean, I have investment properties in real estate development, and you're in a tougher position because not every one of my tenants has realized, you know, from that they might be furloughed and there's been some payments that were missed, right? So it's tough when that cascading effect happens back on the landlord. And there's things that are available, obviously, that you can tap into with some of these loans to hopefully cover and bridge the gap. But from an underwriting standpoint, it's just looked at as a higher risk right now. And the biggest thing that they want to just see is reserves.
And as far as the high-end market, Bill, and this is just my opinion, that it's going to be tough to sell those higher priced properties. And part of it is we were talking about the jumbo loans kind of going away unless you're able to put 20 down. So what do you see for that higher end market where, you know, they need a larger loan?
Yeah, that's a market that dried up really quickly. And that's all. I think that market will actually come back really quickly because a lot of that higher end base has a lot more in reserves. When you're buying a bigger home, you know you have to make a bigger payment. And I think people will be able to still qualify for those loans now. I mean, we got to really low down payments like 5%. Those are going to go down right now. But I expect those to come back pretty quickly for qualified people. Meaning you could put the 20% down, but you don't want to take money out of your retirement account right now when you think the market's going to bounce up. So I think having the market low when we first come out of this is a tough thing because a lot of those people keep their money in the market and maybe don't want to pull it out right away. So I think there could be an initial sputter to that market. But I actually think, I really think the high end is going to do better than you think because you know, I think people have been stuck in their house for a little while right now. And what they're realizing is if I want to be self-sufficient and this ever happens again, right, then they're going to want to do things like, for instance, home offices, nice home offices, you know, is something I think people are going to want. They may want like the pool amenities, you know, they may want just the larger space. They may want the yard. You may see a little bit of a move, I don't know, but from higher densely populated places like, you know, the cities where outbreaks will happen more quickly. So I think no one knows how this plays out, but it's a really interesting dynamic, you know, that's going to go in a couple different directions.
Right. Yeah. We were talking about, you know, after the Depression, what things people, how behaviors changed, and it was all about, you know, having 3 to 6 months reserves. That's a goal. Working toward that, you know, living under your means, like not buying the largest home you can afford, but, you know, being more conservative, maybe going out to eat less, you know, not buying all the stuff we think we need from Amazon. I think, you know, that might be, I don't know how long that'll stick around for, but that seems like a wave that's going to happen at least through the end of the year, maybe for a couple of years. People are going to tighten up a little bit in general.
Yeah, I think they will tighten up a little bit in general. I mean, during the Depression, the big thing was how the banks were just able to take your property from you. So that's why our grandparents always told you to pay off your mortgage, which is we all know is not the best case scenario. In most cases, although when the stock market drops like this, you can maybe make an argument for it. But, you know, I think things will normalize. But that's why our grandparents were taught that way. Their parents, right, told them that's the way you'd be able to own a home. Because if you know, let's say you had that $500,000 home right now, or go back to the Depression where, you know, much lower loan amounts, and you only owe 10% of it, or you only owe 10% of the farm. Well, you didn't make your payments, they could just take your home. So much easier than how the consumer is protected today, and the foreclosures and things like that, which, you know, that's one of the other things that what happens with the real estate market. If they, you know, if people do go into these default modes, do they let these homes work through the system, or do you see these extended foreclosures that, you know, just are a drain on the system because you can't get them back fixed up, sold, and you can't get people out of the homes when they're not making payments? Those are going to be I think the big questions that we have coming out of this, because there's a mentality that's developing of, you know, this is no one's fault, right? In 2008, it was more greed, and there was terrible mortgage programs that were out there where you could state your income and state your assets, and you didn't need reserves, and real estate values were always going to go up. And we were in the strongest real estate market we've probably ever been in, you know, from a supply demand issue. So, you know, do we come out of that and there's 50% of the buyers or 60% of the buyers? I think it will normalize quicker than we think, you know, depending on what the fall and, you know, the next year or so looks like.
Mm-hmm. Anybody else have any questions on your mind? Anything else we missed?
No more fun mortgage reserves questions.
That was pretty thorough. Thanks, Bill.
Cool. Yeah.
Anything else you want to mention that could be useful information to anybody else out there?
Just, you know, we're trying to get the information out to especially the people, you know, business people that we know and we work with that are in the industry. But any questions you guys have, feel free to give me a buzz anytime. We're trying to get, you know, our social media messages out at least once a week, just updating as things come out. Because again, they are updating daily for the most part. So I can certainly get those out to you, or if you want to share them at any time, you're welcome to do it.
Absolutely. Yeah, I know things change by the day right now. So it's best to have the most up-to-date info. So thank you.
You'll put approved mortgage links in the Facebook.
Yes. Yep. I'll put your contact links in the description of this video. And we can also send you the video as well.
Cool. All right.
Awesome. Thank you,
Thanks, guys. This was
All right.
really
Thanks,
helpful.
guys. Talk to you soon.
Bye.
Bye now.